Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update with our friend and colleague, Craig Hemke. Craig's the founder and editor of TF Metals Report, and we will put a link to that down below so you can follow along with the rantings and the information he shares with the community there. It's a great community, and Craig always shares interesting ideas with the folks there. And we're going to find out what he's looking at with the macroeconomic updates for this week. Now, Craig, it's been since the middle of July since we talked to you. And when we talked, I think it was on the 15th of July, we were talking about the breakout in silver, that the mining stocks, that the juniors were starting to get a bid, that copper was ripping higher because of the anticipated, tariffs and what that was going to mean. And so it was a pretty ebullient market back then. Only a couple weeks later now we check in with you and copper has fallen out of bed, silver's corrected, some of the stocks have rotated back down again. But it also seems like the market was looking at a macroeconomic picture then that has changed slightly over the last couple of weeks. So just from a big picture, when you look at the Trump administration, when you look at global trade, when you look at what's happening with interest rates in the Fed, what is on your mind as far as the macro stew that we're seeing in the marketplace here in early August?
Yeah, hi, Shad. It has been a rather tumultuous 3 weeks. That's for sure. You go back to that, whatever day that was, about the 10th of July, maybe, when Trump suddenly tweeted that he was going to put 50% tariff on copper, and copper went about 10 or 15% higher to new all-time highs, at least for U.S. COMEX copper futures. And then, that kind of dragged along silver and platinum and palladium too. And all three of those metals have, their own specific supply demand dynamics, but they kind of played along with copper. So then we got this kind of double whammy of the dollar turning around, the FOMC decision, some hawkishness out of Powell that also helped to rally the dollar. And then Trump announcing, you always, these days, you always got to be wary from tweet to tweet, hour by hour. Trump announcing that refined copper was not going to be subject to a tariff, and copper falls 20%. So then you get this kind of whatever had been priced in or built into silver and platinum and palladium because of the copper tariffs, and that goes out too. So anyway, the big part of this, I guess the kind of the long-term helpful part of this, was about 2 weeks ago, everybody was getting way too excited. I kept reading on Twitter, silver was going to the moon and the next target was $48, by the end of July and all this kind of stuff. And I'm like, man, that just ain't how it works. I mean, you and Corey have known me long enough, it's 2 steps forward and 1 step back. Well, guess what? We took 1 step back. The old adage at TFMR is if you're trading, you've always got to be prepared to sell some when things look the rosiest, which was 2 weeks ago. But you've also got to be ready to buy some when things look the most bleak, which was about Wednesday or Thursday of last week. And then lo and behold, just when everybody thinks the dollar's going to the moon and the metals are done and all this kind of stuff, we get this jobs report fiasco on Friday. And now we're charging higher again. It has been a crazy 3 weeks, but a very constructive 3 weeks. And I'm encouraged at this point that we're going to see ourselves a late summer rally.
Well, Craig, you had mentioned off mic to me that, the good news is when you put on your big picture macro hat, that Trump has communicated where this is heading and that people can kind of lean into that. Maybe unpack that idea about where you see interest rates going, where you see trade and tariff policy going. Give us the big picture look on where you think the market is developing towards.
Well, I think they've made it very, very obvious that if Trump can find a way to fire Powell between now and May, he would. From everything I've read, he's got to do it for cause, which is why you see all these stories in the news about cost overruns and fraud as they try to redo the Eccles building for $3 billion or whatever it's going to cost. The Eccles building is where the Fed headquarters are. So they've kind of tried to build that case, but, none of that is stuck. So, we may be stuck with Powell till the end of May, but it is very clear that Trump is going to nominate somebody for the Fed that is going to do what he wants. And Bessent's been talking about kind of a combined, let's call it an entity. I don't even know if maybe that's too strong of a term, but kind of combining the operations of Fed and Treasury, which is another wink, wink notification that yield curve control is coming. Because if they're going to cut short-term rates to 1 or 2%, which is what Trump wants to do, you might need yield curve control so that if the bond market sells off, the Fed just says, hey, we are a buyer, or Fed with Treasury, we are a buyer of everything over 3 or 4% in the 10-year. to kind of hold those rates down. Anyway, all this is coming. They're signaling that all of this is coming in 2026. So you can look at, I frankly, every single dip now as a buying opportunity. I don't know how shallow or deep dips will be. And you don't know, if the stock market collapses and all of a sudden, everything with a bid gets thrown out, with the kitchen sink, how we've had periods like that before, most recently back in April. So you don't know how those things will play out, but they are telling you what's coming. And it's all of what the three of us here on your program have discussed for years. Lower interest rates, yield curve control, sharply negative lower real interest rates as a way of managing or trying to manage the budget and deficit and debt issues. This is all coming. Some of this maybe sooner than later with the jobs report stuff that we saw last week.
Well, Craig, just a quick side tangent to what you were saying, but related to it. I think most people that understand free markets see central banks as an abomination. That's why there was a book, The Creature on Jekyll Island, when the Fed was formed. But central banks in any country, they're interfering in the free markets. If you think about the concept of the Treasury and the Fed acting in unison, even people that despise the central banks and want there to be true free markets because of the intervention that they do, wouldn't it be even more intervention if the Treasury and the Fed were working together? At least up to this point, Powell was his own man and could be independent, even though the Fed is politicized very much so. They still are somewhat independent of the government because it's a private, entity. If they are working in unison with the Treasury, doesn't like that kind of yield curve control you're talking about, isn't that direct market intervention? And do we even have free markets at that point?
Oh, sure. Absolutely, Shad. We can have discussions about that, theoretical between you and me and the lamppost. But in actual policy, in an actual procedure, I mean, they're telling you that this is what's coming. I mean, we are at these kind of end stages of this debt-based monetary system where the debt is out of control and there's no stopping the train. I mean, we're running another 2 trillion this year in a year that's allegedly full of strong economic activity. The only way that this situation can be managed is through that type of direct market manipulation of kind of a Fed Treasury beast. And I just have always thought, I mean, since I started my site 15 years ago, this was eventually how it was going to go. That you'll have this kind of combined entity that attempts to manage the accumulated amount of deficit and debt and lower interest rates at the same time so that you can manage that. I mean, again, we're already paying over $1 trillion a year in interest expense at what an average yield of 3.5%. I mean, if that goes to 7% by market forces, well, now all of a sudden you're talking $2.5 trillion a year just to service the debt. So they have to do it this way. Again, we can talk about, how bogus it is. And maybe once things reset, we can all fight, with pitchforks and torches. We can run to Washington and try to get them to do it the right way next time. But in this intervening stage where they're trying to manage the last legs of the system, I don't think there's any doubt. There's no doubt in my mind that that's what's coming.
Well, and if you think about it, it kind of harkens to what Japan has been doing for a long time or what China
Yeah.
has tried to do, where they're intervening in the bond markets and also fiscal policy simultaneously. So the fiscal policy and the monetary policy are kind of rubbing each other's shoulders. If that's the case and we have that kind of an environment in the future, what do you think happens to interest rates if they can't keep a lid on it? And as you say, if the markets push interest rates higher, because most people believe the bond bubble popped in 2020 and we're going to see a decade to multi-decade crash in bonds, where that would mean higher yields. What would higher yields do to all that debt if they can't put a lid on it, and if they can't put the genie back in the bottle?
Well, I think they will, though, Chad. There is that risk, I guess, of general buyer strike. The treasuries get dumped quicker than the Fed slash Treasury Department can buy them. And by buying them, they're capping. They're just saying, let's just pick a number, 3%, whatever. We are a buyer of all 7 to 30-year debt. That's anytime it gets above 3%, we're going to come in and buy it. A little bit like the London Gold Pool used to operate, right? Anytime price gets above $35 an ounce, we're going to sell physical gold to push it back down. If it gets below $35 an ounce, we're going to buy physical gold to move it back up to 35. And again, obviously that failed spectacularly after 7 years. And as you've seen in Japan, they can no longer do it either after however many years. But the US is headed that direction. That's what they did, actually. I'd invite anybody to Google this. You can find the old Fed research papers. It was the actual policy of the Federal Reserve in the years after World War II, where debt to GDP got to, however you want to measure it, 125%. They were able to manage that debt back down through yield curve control, sharply negative real interest rates, basically paying off yesterday's debt with the cheaper dollars of tomorrow. That's what they're going to try. Remember a lot of the discussion early in the Trump administration was about, we're going to fiscally responsible and we're going to doge this and we're going to cut that. And none of that ever happened. And the conversation now shifted to we're going to try to grow our way out of this. Okay, which again, I don't think is feasible, but that's what they're going to fall back on. And as part of the growing their way out of that comes with very easy money, very cheap money policy. And again, this is a extraordinarily positive, long-term fundamental thing for gold, but then also silver. And then, by extension, everybody can do the math on mining shares too.
Well, if they're going to grow their way out of it, that just means more inflation coming down the road. So what kind of an environment is going to be if they're trying to do yield curve control, but inflation is ripping higher? How would that work? And what does that mean for the dollar as well?
Right. It's going to be a mess, right? And the dollar is going to be falling dramatically. I mean, there's a lot of moving parts that they got to try to manage. But I think the signs are there. They're telling you this is coming. Trump is going to nominate a very dovish Fed chair that will work hand in hand with Trump and Bessent to try to manage this situation. And it's coming as soon as next year. It may come sooner than that, though. I think with the data that we got on Friday, and this, to me, this is why Trump was so angry. One, the BLS, we call it the BLSBS, right? At my site. As long as I've been doing this job for 15 years, it's been a joke. The monthly jobs numbers where they try to tell you on August the 1st exactly how many jobs the U.S. created in the month of July. And people take it as some kind of Bible gospel truth. That's impossible. But yet through their statistical guesswork, a handful of surveys and a bunch of seasonal adjustments, they think they can tell you. I mean, the whole thing is flawed in the first place. But Powell was using those job reports as, well, the economy is robust and the job market is strong, and therefore we can't cut rates. And therefore he gets sideways with Trump, who wants him to start cutting rates months ago. Well, now all of a sudden we find out that it really was all bogus. And the U.S. is maybe cranking out 20,000 jobs a month instead of 200. And so Trump, not only do you got to get better data to remain, so that you can even begin to believe the integrity of it, but two, it's resulted in a policy error that Trump's been railing about. That Powell should have been cutting months ago, and instead he's not been because he's been looking at blatantly terrible data. So anyway, Powell's going to start cutting. The only question will be whether he makes it to the September meeting before he cuts, whether when we get to September we get 50 basis points like we got in September of last year, right before the election, I might add. And then how many more cuts are coming by the end of the year? Anyway, all of this, it's hard to envision a scenario where gold prices go into some kind of deep, sharp pullback, with this as the macro and monetary environment.
Yeah, it's so wild, especially because, like you say, Powell was using these jobs reports data for his thesis, but then they revised back the prior 2 months and they're terrible revisions down, and you realize this data was already sketchy to begin with, but now these revisions show just how off it really was. And if you're basing your policy on data that's wrong, then your policy decisions are wrong too. So it's getting to an apex. But if we look at gold, to your point, we're still above 3,400. It's holding up well. If the dollar was to fall off more, or if there is more financial turmoil, we're still going to see gold and gold stocks hold up well. Silver still above 37. People are crying in their beer about it, Craig, but I remember when people were rooting for silver to get above 30 for the longest time. Now we're at 37 and people are upset because we were just at 39 and people thought going higher. But like you say, we need to have these little pullbacks, how are you looking at precious metals, where they're positioned today in lieu of all these other factors we've discussed? Are they poised for the next run higher? Are they in a consolidation? Would you be concerned if we saw a pullback? How are you looking at the precious metals overall?
I would not. I'm thinking that gold's now going to rally. The seasonally, August into September is one of the strongest times of the year for gold prices. That combined now, we've had this kind of perhaps what might end up being a counter trend rally in the dollar that faked everybody out. So the dollar starts to fall again in anticipation of Powell at Jackson Hole later this month and then the September FOMC. The dollar even just goes sideways, between 97 and 99. Then we've got an environment that's going to be conducive for more funds and speculators and the like to be buying gold futures and investors to be buying gold. So I think we've got a rally on our hands now. The previous four times that the price of gold has gone up to about 34.50, or now on the December contract, that's about 3,500. I mean, the very next day, price has been smashed backward. So it's happened four times. Maybe the fifth time it gets through. It wouldn't surprise me, given the run we've had in silver from, what was it, 27 at the lows back in April to 39 in late July. It wouldn't surprise me if we don't enter another one of those periods where, gold adds about $200 and silver kind of ekes out $1 or $2, and people are, frustrated and angry because they're like, why isn't silver going up twice the amount of gold? It will again. But, the COT report remains heavy. I could see silver moving higher and maybe tapping, 40, 41, that kind of thing. But I'm still not convinced that we are, this silver's going to 80 by next week type of thing. I'm not in that camp. 15 years of following it has kind of made me look a little more realistically at it. I think as we get into next year and all of this starts playing out and we start talking about $4,000 gold, then we're going to be talking about silver going back up to the old highs from 1980 and from 2011. And people, oh God, what's going to happen next? And then when it goes through those levels, that's going to set off a little mini mania. But again, for me, I think that's more of a 2026 issue than it is 2025.
Well, just one last question, Craig, and it's more on the gold and silver equities. When you think about the discussions we were having a year or two ago, we were talking about one universal chart, and everything seemed to be reacting the converse of what was happening to bonds and the dollar. Now things have kind of split apart for a while, and coming into this year, the first quarter, we saw gold and gold stocks be the top performing assets and just crushing what was happening in the equities markets. In Q2, it was a roller coaster ride, as we just discussed, because April was the tariff tantrums, and then May and June, we saw a V-shaped rebound almost in everything, whether it's general markets, cryptos, commodities, across the board. But you saw gold and gold stocks going up the same time as just U.S. equity markets and the same time as cryptocurrencies, and just a melt up and everything. Do we need to see the one universal chart break back down like we saw in Q1, where we see the precious metals diverging from the other equities, or are you worried that if the markets roll over, that it pulls the gold and silver stocks down with it?
Well, that's always a risk, right? We saw that back on Friday. Gold had this great day, shares opened higher, and then they just kind of sold off over the course of the day as the S&P fell 100 points, because they are shares after all. I think in a bigger picture, Shad, there's really something noteworthy going on. If people look back at the chart, say of the GDX, there's a massive head and shoulder top on the monthly chart of the GDX that was back in 2010 through about 2012 into 13. Two shoulders at 55 and a head at about 65. And man, when that baby broke down, it spelled doom. And we all had to live through it, right? For 7, 8, 9 years. Well, that's a reason why the GDX now keeps banging up against 55 and is unable to get through there. I think the action, though, today is insightful as we record this. Agnico, after this unbelievably great earnings report last week, sold off, right, as gold was going down. And I think there's a belief amongst, kind of generalist investors. It's like, it just still can't believe gold's 3,500 and it's got to pull back, doesn't it? And that kind of stuff. And if it does, then Agnico won't make as much money in the third quarter. all that kind of stuff. Well, today, with gold now back above 3,400 and, all these things we've been talking about, what Agnico's at making new all-time highs north of 130. And I think that's telling you what's coming. As we now move in, through this third quarter of the year, and my God, Shed, we're already more than what, about 35 or 40% of the way through the third quarter. If it becomes apparent and if gold breaks out and it goes above, like I think it's going to do, break out of this range and start moving higher, there is going to be a cattle call into the shares. Because people are like, oh, crap. I guess gold's not going down. I guess gold's not going back to 3,100. Oh, my God. What's Newmont's and Agnico's and all the rest? Kinross, I mean, you name what are their earnings going to look like in the third quarter? And there's just going to be this rush into the shares. I mean, I know we've already had a hell of a year, but the next leg higher might catch a lot of people by surprise, and it might be something else.
Well, it sounds like it could even surprise a lot of the bulls because it would be stronger. Hey, if we have a cattle call into the mining stocks, I don't think anybody listening to this interview is going to be crying any tears. That would be a wonderful thing. So we'll wrap it up on that note, Craig. But definitely a lot of macro forces coming together to support what should be a strong precious metals market anywhere you slice it, whether it's the Fed monetary policy, whether it's the Trump administration's fiscal policy, going from Doge and cutting with chainsaws to spending like a drunken sailor. So if we have all of these factors coming together and inflation tick up at the same time that the dollar's going down, we should still see a backdrop that's very positive for the precious metals sector. And even if there's a market correction, it's still possible we could see a divergence like we did in the first quarter, where some of these equities, even though they are equities, still hold up. So looking forward to the cattle call when it comes in, Craig. And those of you that are listening, if you want to follow along with Craig and his analysis and get into the community over at TF Metals Report, definitely click on the link down in the show notes. It takes you over there. He does a great job of covering the space, but also covering a lot of the reports, like the COT reports and a lot of the data and crunching the macro data on the jobs and looking at inflation. So I highly recommend checking out TF Metals Report. And Craig, until next time, looking forward to our next conversation.
Thank you, Shad. And one last thing. Moo.